Hooty hoo, all my stock market gamblers. Welcome today. I'm Tall Mike. It's Wednesday. We got the Dow Jones down about 200, the Nasdaq's down about 70, but really their markets aren't going anywhere. They're in a sideways pattern. Which way they break? Will they break up or will they break down? My guess is we're going to get a pullback. Now, why do I think we're going to get a pullback? I think we're going to get a pullback because there's a lot of fear in the marketplace still. And now we're sitting right below the 50-day moving averages. Okay, so the Dow is right below it, the Nasdaq and the SPY is right below the 50-day. Now, if you look at the Russell, which is the IWM, it's sitting right on the 50-day moving average. Now, this 50-day moving average is now resistance. Now, do I think we're going to get through it? Yes, eventually I think the market's going to go a lot higher. But right now, I'm expecting a pullback. I'm expecting a pullback in the marketplace. Now, why do I expect this pullback? Well, there's fear, right? But the other thing I look at is the junk bonds, the HYG. And when you look at the junk bonds, it's a sign of is risk on or risk off. Now, the junk bonds were coming down. They were collapsing. They were just free falling as the stock market was collapsing with them. But magically, they found the bottom. Someone went in and started buying the junk bonds. Now, who could this someone be? Well, people would be not in their right mind if they were buying junk bonds. So I think it was the Federal Reserve. I think it was the Plunge protection team that came in and started buying the junk bonds. Now, junk bonds tend to lead the market. So they started to lead the market up in this upswing that we have, but recently the junk bonds have been coming back down, and that's why I'm expecting a pullback. Now, what exactly are junk bonds? Junk bonds are the bonds that are owned by zombie companies. What's a zombie company? A zombie company is a company that doesn't bring in enough cash flow to even make their payments of debt. They are called the zombie company. Now, soon we're going to be called the zombie country because our debt's going to be so big, our tax revenues are not going to be big enough to even pay the debt, the interest on the debt. We will become a zombie company. But there are a lot of zombie companies in the S&P right now. In the S&P 500, about 100 of them are zombie companies. Now, why are zombie companies even in existence? They have a bad business model. Well, this happens when artificially low interest rates, the Fed holds interest rates artificially low, allows these zombie companies to exist. It's called malinvestment. And as long as you don't have any bear markets, any recessions, these companies don't get flushed out. A lot of these companies are going to go broke. They're going to go bankrupt. They're going to go away. They have a bad business model. They should never be in business to begin with. But the Federal Reserve keeps buying their junk bonds, keeps buying the corporate debt of these companies so that they can keep them alive, so that they can keep them in business. Because once they start dropping out, once they start going bankrupt, well, what happens? Well, the stock market goes down. And it goes down relatively quickly. And of course, the Federal Reserve doesn't want to do that. So they use the Plunge protection team. Now, I actually believe there's more than one Plunge protection team. Yes, I believe the Federal Reserve is actually buying stocks. I believe they're buying ETFs. They're also worried about the debt market. That would be the second team. The second team wants to keep the debt market relatively stable. So they have these Plunge protection teams that come in and buy, and that's what they did to the junk bonds to make the markets go higher. And that's why we're getting this nice bounce. We're up about 8 or 9% off of the recent low. Now, I do think we're going to give half of that back, come in and fill the gaps before we head up higher. I do think they're going to push this market up again. I think by the end of the June, we will be higher. Now, we got a Federal Reserve meeting coming out, next week, I think it is. Anyways, they're going to raise 50 basis points. That's built in, right? Everybody's expecting that. And I'm sure that's what's going to happen. Now, what's that going to do? Well, let's talk about the real estate market. Okay, now, what's happening happening there? Well, what's happening there is people are not being able to get mortgages. They are not being able to qualify for the homes. The home goes pending, meaning they put in an offer, they get their offer accepted, and then they go to their mortgage broker, and the mortgage broker goes, you can't afford that house. That house is too much money. You have to come and buy a cheaper house. The house falls out of escrow and goes back onto the market again. It's because people cannot afford the house. Now, a lot of people think that, well, the houses are not going to come down. They're not going to collapse. They think that, well, it's different this time, Mike. It's not like 2008. I keep telling them it's much worse than 2008. And I think it's going to crash much harder than 2008. Now, the reason they're saying that it's much better, and I get their point. Now, here's what they're saying. Now, 2008, we had all these subprime borrowers. And right now, we've had good borrowers, and there's a lot of equity in these homes. There's a lot of homes have $200,000 equity sitting in them. But what's happening? People are going out and they're starting to borrow on their equity. That's how they're making their cost of living's gone up, and they got to pay for it some way. So they go out and they borrow money. Look, homes are a dead asset. Now, the housing market would be perfectly fine if there wasn't so much debt tied into the housing market. Now, a lot of countries, you don't see that type of debt. They buy with all cash. They don't give loans. And if they give loans maybe 50%. We give loans out at 97%. Now, okay, so you say it's different this time because the borrowers are strong. Well, right now we've gone back to the subprime borrowers. We're going back to the adjustable rate mortgages. We're going back to we're introducing 40-year mortgages, which is new for the real estate market. But this is all subprime stuff, really, right? We didn't learn anything in 2008. We're doing it again. But here's the thing. It doesn't matter if the people that are already in their house are strong borrowers with a lot of equity. That's not the point. The point is when they restrict the issuance of new debt, meaning that it's harder to get a loan for the people that are going to be buying your house. If no one can buy the houses will come down. And that equity, that $200,000 that you have in equity will be wiped out. And you will actually go what's known as upside down. That equity will get wiped out, and it can happen really quick. It can happen in a nanosecond. Look at interest rates have doubled, basically. That's just called. They were below 3%. They're approaching 6%. And I think by the end of summer, I think we could see over 7%. Look, we're getting a 50-point basis interest rate raise this month, another one next month. I mean, this could push us up to 7%. Now, you say, well, Mike, the Fed's going to reverse course. It doesn't matter. Look, right now, mortgage rates can go up even though the Fed keeps interest rates stable. Okay, so the Fed doesn't even have to raise these rates. You see, they're doing things different now. Before, they used to buy $40 billion a month in mortgages, right? $40 billion a month so people could get mortgages. The banks make you the mortgage and they sell it to the Federal Reserve. Well, right now they've stopped buying mortgages, but here's the thing. They're now selling $40 billion worth of mortgages into the marketplace, and the marketplace they have to assume these mortgages. They have to find buyers for them. And this could send the cost of mortgages up. Now, people laugh when I say this, but look, we went from 3% to 6%. We did it in like 4 months, right? It went really fast. Well, what if in the next 4 months we go from 6% to 12%? Holy cow, Mike, that could never happen. Well, and I agree, it probably will not happen, but yes, it could happen. But my point is, when they restrict the debt of the new buyers coming in, the buyers go away. There's no more buyer. Okay, so somebody's going to have to sell their house. And there's a lot of reasons they may have to sell their house. Job relocation, right? A divorce could happen. Medical bills. There's 100 different reasons you don't even think about that they have to get the home sold. Maybe someone dies and the heirs, they got to get rid of the property so they can settle the estate. A lot of this goes on behind the scenes. You don't get to see it. But there's people that always have to sell. And those people, when the new buyers, the restriction of new debt, they can't get the loans through. They can't borrow the money. Okay, so what happens to the price of the house? The price goes down. The house prices drop, right? Okay, and that equity right now, yeah, maybe you got 200,000 in equity, but what if it gets chopped to 100,000? What if it gets chopped to 50,000? And what if you just went and got a HELOC, a home equity line of credit? You see, a lot of these people that are borrowing on their houses right now, they're not borrowing with new mortgages. Just a year ago, you could refinance your home at a lower rate, keep your payment about the same, and pull money out. That game is over. That game's gone. Right now, you want to protect your low interest rate first. So what you're doing is you're getting a second loan because you need money. If you need money for living, and a lot of people use their houses as their bank account, they need money. And so you go and you take a second loan out, right? Well, these second loans, they're not at the 5 and 6% rate. No, they're at 7, 8, 9%. So if your credit's not that good, you might be paying 10, 11% on a second behind the first. Okay, so you're pulling money out of your house, but your payments are going up because now you got to make the first mortgage payment and the second mortgage payment on top of that. And that second mortgage payment is at a high interest rate. Look at when they restrict the issuance of new debt, because houses are levered, because they're debt instruments, a lot of the equity can go away really quick. The housing market can change fast, right? And, right now I think it's already changed, but a lot of people, they aren't recognizing it yet. And yeah, there's sellers out there. Then houses are still moving. You can still make it out if you want to get out. You can get out at a high price. But I don't think it's going to be a high price that much longer. I think a year from now, we're going to have a glut of homes that have entered the marketplace. And that glut of homes is going to send the prices lower. Right now, we've got the supply of homes rising, right? The supply is going like this. And the demand for homes is going like this. The demand because they cannot afford to buy a home. Sure, maybe they want to buy the home, but when they can't afford to buy the home because interest rates just doubled, that is no longer functional demand. They cannot buy your house. You need to find someone to buy your house. And yes, I agree. Right now, you can find someone to still buy your house. Now, if you're a buyer right now, what do I tell my buyers? I go, look, you better be willing to hold this house for 10 years just so that you can get out at the level you bought it at, because we're going to come down, and I don't know if we're going to even be back to these levels 10 years from now. Now, this is just my opinions. I know a lot of people have different opinions out there, and that's okay. That's fine. You're entitled to your opinion. Just listen to people, look at the facts, and make your own judgments. Anyways, I got a little carried away today with the rant. But if you like this stuff, hit me with that thumbs up. Why? Because it's Wednesday. Get out there. Have a great Wednesday, everybody. I'm Tall Mike. Get out there and have a lot of fun. Bye-bye now.